Well, good morning, everyone. Glad to be here with you virtually, although I frankly miss the person-to-person seminars that we did for a couple of years. The way things will work this morning, as Alain just stated, I've got about a 20-minute presentation here. We'll go through the whole presentation because there's so many of you on the system. We really can't stop and take questions until we get to the end of it. But I want to assure you that there will be lots of time for your questions once we do get to the end of the presentation. So with that, let me see if I can use a little technology here and bring up the presentation. So hopefully everyone can see that. So the title of this presentation, there's always a bull market somewhere. A little bit of a misleading name perhaps, because really the subtitle is, and the most important message of this is about diversifying your investments. And I think that we'll all admit that given the state of the economy and politics and health and everything else, it's certainly a good time to be careful out there. I want to, of course, mention this disclaimer that the Ottawa Branch and this facilitator do not in any way offer any personal financial advice. The seminar and the information is for education purposes only. I want to remind everyone, particularly today, that investing involves risk and personal decisions should be made only after individual due diligence or with the assistance of a registered financial advisor or broker. And finally, that the Ottawa Branch takes no responsibility for any investment decisions that participants may make. I also want to have a few acknowledgements here, people who helped make this possible, from NAFR Ottawa, Linda and Raman, who've organized and are sponsoring the webinars. Michael Patinode from the Ottawa Share Club, whose excellent graphs you'll see in just a minute, and Frank Schilder, who's back there behind the scenes operating as our Zoom master and keeping all the technology working. So thank you to all of these folks. I also just want a quick review on some acronyms and terms because we can't do this interactively. So just to remind people, ETF, you may have heard now, exchange traded fund. It's simply a mutual fund that you're familiar with, which is sold like a stock, usually for lower fees because you buy them more directly. MER, management expense ratio, that's the fees in percent that you pay to a mutual fund or an ETF. A lot of people who buy mutual funds or ETFs believe that they're not paying any fees when in fact those fees are embedded in the performance of those funds. An index is simply a selected list of stocks or other investments that are chosen to reflect the average value of a type of those stocks. So indexes that you hear about, the Dow Jones Index, which is the 30 selected industrial stocks in the United States, the TSX 250, the 250 largest companies in Canada, the S&P 500. All of these are indexes, and they're simply ways that you get an overall average view of what's happening in that particular type of investment. And there can be indexes for everything these days. Real estate indexes, bond indexes, China stock indexes. There's almost no limit. This is a slide that I've been using in my presentations for at least 2 years, and I put it in again because it seems pretty apropos today. There are known knowns, there are known unknowns, but there are also unknown unknowns, the things we know that we don't know. And you will all admit, I believe, that COVID-19 and the situation that we're currently in definitely qualifies as an unknown unknown. We just had no idea this was coming at us. But my whole thesis here is that we have to plan our investing knowing that we don't know what we don't know. The other thing I wanted to point out is that I focus on facts versus opinions. There's lots of opinions out there, CNBC, BNN, Globe and Mail. I try to avoid opinions and I try to provide you with facts and let you make your own decisions. But in doing so, I really want to encourage you to take the time to think about it, think about the facts, even think about some of the opinions, but do take time to think. So here's a good example of what I'm talking about. The value, the questionable value of investing advice and market timing. About a year ago in the Globe and Mail, in the Report on Business, August 2019, there were two articles that I saw that day. The first article said, "The argument for gold is getting brighter by the day." And the second article in the same paper on the same day said, "The argument against gold stocks, don't do it." Both of these opinions came from very well-known, excellent people. And obviously one of them was wrong. But if you were there reading this back a year ago, you would look at these two things and say, well, this is great. What do I do with this information? Well, it just so happens that since August 16, 2019, the price of gold bullion is up 36%. And the gold miner ETF called XGD is up 42%. So one of these people was right. But back a year ago, how would you know? The other thing that's going on in the world is that index investing has really taken over the US markets. And it's a question as whether or not this is working as it should. I read recently that 60% of the US stock market is now controlled by index funds. That's passive investing. That means when money goes into it, it goes into all the stocks in all of the indexes, depending on the size of their valuation. And in fact, over the last few months, 25% of all index money was going into the 5 largest tech stocks called the FANGs. You may have heard of the FANGs. It stands for Facebook, Apple, Amazon, Netflix, Google, and we could probably throw in Microsoft and Tesla if we had a few more initials. The current Standard & Poor's 500 price to earnings ratio, in other words, the ratio of the total value of the earnings of that index to its price, is 28 to 1. The average over time is 16 to 1. So this tells us that stocks are valued expensively right now. So you put all this together and you sort of say, well, okay, what does it mean? Well, there are 2 rules, I believe, for long-term investing success. Rule number 1 is you develop and you stick to a low-cost, emphasize low-cost, diversified asset allocation strategy. And an asset allocation strategy is simply how much you decide to put into stocks, bonds, and various other assets. We're going to talk about that. And the second thing is you got to focus on time in the market rather than timing the market. And if you look to your right, you'll see this area called probability of loss of the S&P 500. In 1 year, 26% of the time, the S&P 500 lost money. You see 3 years, 5 years. Over a 10-year period, it only lost money 6% of the time. Still lost money, and it's still possible that in 6% of 10-year periods, you can lose money. And I'm going to show you in a minute a very long period recently where no money was made in the S&P 500. Nonetheless, if you've got a diversified asset allocation strategy, you can at least protect yourself and hopefully make a little money at the same time. The other thing I wanted to share with you is this slide, which I think is the most important fact of investing. And remember, I said I was going to focus on fact, not opinion. this shows you the returns from every year from 1928 to 2017. And I wish I could find an up-to-date version of this, but this tells you the basic story. The red line is the average return, which is 9%. That includes capital gain and dividends. And you can see that particularly in the period from about 2009, the returns have substantially been above that red line. 2018 was a bit below, 2019 was considerably above, and 2020, who knows? But my point is that this is, as a former colleague used to say, this is not math, this is arithmetic. And over time, things have to return to the average. So that means that if you have a lot of years that have been above the average, you have to have a number of years that are below the average. It's just arithmetic. So what does that mean? Well, let's look at where we currently are with the stock market and look at it since 2000. And this chart shows two indexes, the S&P 500 and the Invesco QQQs, which is the top 100 stocks in the NASDAQ. That is the technology stocks. And I want you to take a look at the year 2000, which we set to 0. And if you go forward, you see 2007 or so, it got about back to where it was. But look at this. It wasn't until 2013, 13 years later, that investors who bought at the peak in 2000 got back to where they were. So in that period of 13 years, the only thing they made was their dividends, which in this case was about 2% per year. And if you look at the NASDAQ, which is the gold line, it took another year and a half or so to get back to its 2000 period. So while it's true that American stocks return about 9% per year, it's also true that you can go through very long periods where they make virtually nothing except dividends. Now, if you continue forward and you look at where we are now, it's since 2013, basically the S&P 500 is up about 126%, and the NASDAQ's up whatever. After the last few days, I'm not sure exactly where it is, but it's probably in the order of 150, 160%. So Jim Cramer, the always enthusiastic host of CNBC's Mad Money, I'm sure many of you have watched him, ends every show with this quote, "There's always a bull market somewhere." And he's right. And I'm going to show you some examples of why this is so and why it's important to have diversification so that you can take advantage of these bull markets. So these are some selected investments that often act very differently than stocks do. Gold and gold miners. By gold miners, I mean gold mining companies. Long-term high-quality government bonds. Selected real estate investment trusts, particularly today, not all. And alternative investments, which are basically all sorts of other things, not otherwise noted, but typically infrastructure. So let's take a look at gold bullion versus the S&P 500. And what I want you to note here is that gold, which is the gold line, reacts almost opposite to the stock market. So if you look around 2000, you can see that the stock market went up and gold didn't do much of anything. You can see that gold started to go up a bit after the 2000-2001 market decline, which was about 40%, and the gold started to go up. During the great financial crisis, when the stock markets went down 45%, gold continued to go up. And it went up until about 2013, which, as you remember, was the point where the S&P 500 got back to its 2000 level. Then it declined. And in the last couple of years, it's been going up again strongly, mainly in relation to the fact that interest rates got so low. So gold has what's called negative beta. Negative beta simply means that it reacts negative to the stock market. So it reacts opposite. Gold miners, on the other hand, have positive beta to gold. And what that means is that gold miners tend to go up twice as fast as gold does. Unfortunately, they also go down twice as fast when gold goes down. But it just shows you that an investment in gold miners can be sometimes extremely profitable, particularly when gold is going up. And that's what's called positive beta. The other thing I want you to look at is what long-term government bonds do. And a lot of people think that because bonds are so low in value that they make a lousy investment. I mean, back in 2019, who was going to buy a 30-year bond that pays 33%? But if you look at this, and the gold line is the interest rate on a 30-year US Treasury note, and the blue line is the value of the bond, you can see that in about middle of 2019, they diversified tremendously. And even though interest rates went from about 3% down to 1.4% for a 30-year bond, the value of the ETF that tracks them went from about $48, $50 to $67. So a lot of people forget or don't understand this relationship between interest rates and the value of a bond. And when you get down to these very low interest rate levels, a small change in interest rate can have a huge effect on the value of the bond. So here's an example. Let's say you have a 30-year US government bond that currently is paying 1.4%, which in fact is about what it pays today. If that rate drops to 0.9%, the value of the bond increases by 13%. So a 0.5% change in interest rate generates a 13% change in the value of the bond. Now you might say, well, Michael, what bond is going to go to 0.9? Well, in Europe and lots of parts of the world, a lot of government bonds are actually trading at negative yields. In other words, you pay to own them. In another example, the government of Austria last summer issued a 100-year bond that had an interest rate of 0.88 for 100 years. The other area that is worth looking at are real estate investment trusts. And you remember these are companies that basically buy and operate everything from apartments to retirement homes to shopping centers to warehouses. And this graph compares two things. One is the CI First Asset REIT ETF to the XIC, which is the TSX return. And you can see the returns going back starting in 2005. So in that period, the TSX, the gold line's up about 100%, and the REITs are up 243%. And it's even more than that because this doesn't take into account all of the tax advantages that REITs have. Often the way they pay their distributions are tax advantaged in a taxable account. Alternative investment examples, just to give you some ideas: cell phone towers, urban and water gas distribution, gas pipelines, toll roads, container ports. These have gotten to be very popular with the big pension plans. Now you're saying, well, Michael, this is great, but I'm not going to be buying any container ports. Well, luckily, of course, the financial industry has come up with a way for you to actually buy a piece of these. And here's one example. It's a company called Brookfield Infrastructure. It's part of the big Brookfield conglomerate. I liken it more to a managed ETF because they own assets all over the world and all of those things I just mentioned. And if you look and compare their performance going back to about 2015, you can see that they have outperformed the S&P TSX, which is the bottom blue line, by almost 3 to 1. In addition, it pays a good dividend of around 4.5%. And the nice thing about things like these sorts of companies that act like ETFs is that there's in fact no MER. So what are some investment vehicle examples you can use? And you can go back to these later, but for gold bullion, there's a number of ETFs available in Canada, MNT, CGL, CGL.C, and you can see the MER on it. There's a gold miners ETF, XGD. There's a long-term government bond ETF. It's US bonds, but this is in Canadian dollars, called ZTL. There's a REIT managed ETF. In this case, I like the managed ETF because I'd like to have some brains picking what kind of REITs to invest in this current environment. The MER is a bit high there at 0.98, but if you bought exactly the same thing in a mutual fund, you'd pay almost 2%. And then there's some all-in-one ETFs that I'm going to talk about here, who are now available from a bunch of different companies, and they're essentially a one-stop solution. So here's some examples from Vanguard. And I just use Vanguard because they were the first guys to introduce them, and they've got some of the best graphics. But if we look at the bottom here, there are 7 individual ETFs that they use to make up these overall asset allocation ETFs. So if we focus on VBAL in the middle, it's 60% stocks, 40% bonds. And you get that plus stocks of the world, bonds of the world with one buy. VGROW is 80% stocks, VCNS is 40% stocks. And then they've got 2 more, even more conservative. This one is 20% stocks, VCIP, and the one on the right is 100% stocks. So these are asset allocation ETFs. And I'm going to have a webinar just talking about these alone in about 4 weeks. So here's performance for you to compare, just to see how they've done. So VCIP conservative, it's up about 8% in the year. The reason for this is because it has a lot of bonds, and bonds did very well as interest rates came down. VBAL, which is sort of your in the middle one, 7.6%. VGROW, and compare this to the VCN, which is the TSX ETF, which was up only 1.5% at the same time, and VUN, which is the S&P 500 in Canadian dollars, which was up almost 16%. So by using one of these balanced ETFs, you got bonds, you got US, you got some Canada, but you had a better overall diversified portfolio. So how do you put this all together? Here's one example. I call this the always a bull market somewhere model portfolio. Now remember, this may not be right for you, but it's just an idea. So you start off with one of those balanced ETFs, maybe 80%, a gold bullion or miners ETF at 5, a REIT ETF at 5, an alternative ETF like company like Brookfield at 5, and cash at 5. Because I always like having some cash around for when the bargains come available. And I'm pretty sure there's going to be some bargains available soon. So disclosure, my family and I hold the following: VBAL, XGD, RIT, ZTL, BIP. So I essentially put my money where my mouth is. And just to remind you, next seminar is coming up 2 weeks from today. We're going to have one that's going to focus just on gold. Gold as portfolio insurance. Then bonds and preferred shares, which can still make you money and particularly generate income. And then on October 21st, the one decision investment portfolios, these all-in-one ETFs that I just showed you. So we'll stop there and open the